notable for being a pretty astute venture capitalist out your way. It's good to have you on with us. Welcome.
Thanks for having me. I feel like I should be hiding in a bunker today.
Yeah, seriously. I mean, what do you make of what's happened with tech of late?
Well, it's interesting you mentioned the JP Morgan comment about rotation. I mean, there's been such a concentration in the Mag 7. I was at a dinner last week with Mark Mahaney, who comes on often, and a group of 30 public market investors, and I was shocked how many of them are still concentrated in the Mag 7. So hopefully this is also a chance for people to go discover some new names. There are some great small and mid-cap software companies out there. Seema mentioned CrowdStrike. They're reporting tomorrow. It's up 46% in the last 6 months. That's a software company in the cybersecurity space, which we continue to see be a very important space. Certainly doesn't get less important with everything going on in the world. And you've got a bunch of great private companies like Drata and Wiz and others in that space as well. So that's a space we're excited about. And maybe we will start to see a rotation with folks looking for some newer names. We had a pretty good IPO market last year. It was not as strong as it was in 21, but the names that went out have done really well, something we can talk about. But I'm hopeful that this will cause some folks to maybe look around and look for some new ideas.
I mean, how could you, have a good feeling right now about the roadmap and the runway for IPOs with tariffs and the amount of uncertainty that seems to be at play? The market, upset in its own right is not great for capital markets activity. You put all that in total, and does that, make you rethink what you were thinking at the beginning of the year, perhaps?
Well, and Scott, as you know, it's easy for folks to go by Google, right? It's trading at 18, 19 times forward earnings. Meta, Amazon, these are safe names. Microsoft, that people have been hanging out in for years. And so to get them excited about new names, we probably need lower rates or a signal of lower rates or just more appetite for risk, which certainly you're not seeing today. I think the thing that I would just sort of contrast that with is the optimism and the energy that everybody in Silicon Valley has right now around AI. I mean, it's so early, and yet we're already seeing major corporations spending millions, if not hundreds of millions of dollars on new software and new technology around AI. I just don't think it's hit the radar screen of many public investors yet, because so many of the companies that are benefiting and winning in the category right now are still private. Obviously, you have high-profile names like OpenAI and Databricks, but tons of great private companies that folks haven't even heard of. And those companies are winning. They're benefiting big time right now. It just probably won't hit people's radar until some of those companies go public.
I mean, not to mention Anthropic, which had news today, obviously, a raise post-money, $61.5 billion. When you see the eye-popping numbers that these valuations are getting to, what's your reaction?
Well, look, there's a lot of money around the world. There's more private companies, over 100 million of revenue in the world, than there are public. And we have fewer public companies today than we did 20 years ago. So at some level, you've got capital around the world chasing a small number of companies that are doing really well. The other thing I would just highlight, Stripe came out with their annual report this week, and in it they had a great chart that showed the growth rate of AI companies versus the growth rate of prior generation software companies. And these companies are growing much faster with fewer heads and are going to be more profitable over the long run. So I think the enthusiasm is warranted. And at some level in the private markets, we don't have a market where you can just buy and sell stocks every day. You're locking in these investments in these companies for hopefully a 7 to 10 year window and hopefully seeing liquidity down the road. But it's just scarcity. It's a lot of money from around the world chasing what everybody knows is a generational shift that's going to create trillions of dollars of value. So it's not surprising.
I wonder, though, if there's risk within that of inflating bubbles, right? Fewer places to put even more money, so they go towards the top.
Well, the thing we all have to remember, if you think about the last bubble back in 99, 2000, there were roughly 200 million people on the internet in 2000. Today, you've got billions and billions of people that are already sitting on platforms like Meta's got 2 billion users. ChatGPT, fastest growing consumer application in history, went to 200 million in under 2 or 3 years. So the point at which these companies are entering the market, whether you think about small business, enterprise, consumer, the groundwork has been laid for these companies to grow at an accelerated rate. And I think when we talk about bubbles, let's remember the infrastructure spending is being funded by cash flow at Microsoft and Google and Amazon and Meta. It's not like they're going out and raising capital like companies were in the late 90s and early 2000s to fund that expansion of the internet. It's just a very different climate with a much bigger end set of opportunities. And I think that's why you're seeing so much excitement for these companies.